Hey everyone, Larry Bailey here with Awesome Technologies, bringing you another weekly newsletter. This information, of course, is compiled by MBS Highway, your trusted source for mortgage market intelligence, and make sure you get over to mbshighway.com to get all this information live. It's also brought to you by Awesome Technologies Inc. Listen, if it involves Encompass, or if it involves Byte, or if it involves any type of LOS that you're using, including the Meridian Link platform, make sure that you get over to awesometechinc.com. There is literally nothing that we cannot help you with over there. And thankfully, it is ATI who lets me do all this cool stuff to bring this information to you. So let's give them some support, shall we? Let's get into the newsletter. This is from May 6, 2024, and we're going to review the week of April 29th, 2024. The Fed once again held rates steady. The labor sector data showed signs of softening, and there's more evidence of rising home values across the country. Read on for these stories. And here we go. And by the way, if you're listening to this on podcast, thanks very much. You could head over to mortgage.community. If you don't have an account there, you can sign up. It's free. It's open to everybody, regardless of who you work for or what you're doing or what your background is, etc. Get this information. I do believe it's important. First story, Fed shuts down rate hike chatter. Next story is jobs reports shows softening. Next story is private payrolls beat estimates. The next story is job openings hit 3-year low. The next story is trends in unemployment persist. And the last story we'll go over is home price gains continue. So listen, it's now May, and if you roll the clock back and listen to some recordings back in January, February, it was rates are going to get cut. Rates are going to get cut. Yeah, well, here we go. So after 11 rate hikes since March 22, the Fed once again left their benchmark Fed funds rate unchanged at a range of 5.25 to 5.5. The decision was unanimous and marks the sixth straight meeting they held rates steady. The Fed funds rate is the interest rate for overnight borrowing for banks from the Fed, and it's not the same as mortgage rates, of course. The Fed has aggressively been hiking Fed funds rates throughout the cycle to try to slow the economy and curb the runaway inflation that became rampant over the last few years. Bottom line, after some recent inflation readings were hotter than expected, some economists wondered if the Fed would resume hikes to the Fed fund rate. However, Fed Chair Jerome Powell emphasized that a hike was, quote, unlikely, close quote, adding that the Fed would instead keep the Fed funds rate at its current level if tighter conditions were warranted. Powell also reiterated that the Fed does not expect to cut rates until members are confident that the inflation is moving sustainably towards their 2% target, as measured by the annual core personal consumption expenditures, also known as PCE, which is at 2.8% as of March. However, a sharp rise in the unemployment rate, which has been in a narrow range between 3.7 and 3.9% since August, could also impact the timing for rate cuts. While the Fed's latest forecast showed that 17 of 19 Fed members don't see the unemployment rate rising above 4.1%, an increase over this level could pressure the Fed to cut rates, given their dual mandate of price stability and maximum employment. So there you go. We'll see what happens. Here's the next story. Job reports showed softening, and there's a nice image on here brought to you from MBS Highway, and the source is Bureau of Labor Statistics, and it kind of outlines November through April, and it gives you both a bar chart as well as a line graph. I'm going to show you what's going on here. So the Bureau of Labor Statistics, the BLS, reported that there were 175,000 jobs created in April, which was well below the estimates of 243,000 new jobs. Revisions to February and March shaved off or reduced 22,000 jobs from those months combined. And the unemployment rate, that rose from 3.8 to 3.9%. So here's what's going on. The headline job number comes from the Reports of Business Survey, which is based predominantly on modeling and estimations, in case you didn't know. In fact, one of the biggest reasons we saw job gains last month was the birth-death model, where the BLS estimates new business creation relative to closed businesses and how many jobs this created. In April, this modeling added 363,000 jobs to the headline figure, which would have shown a loss of 188,000 jobs otherwise. Average weekly hours also declined slightly, which is important because one of the ways businesses cut costs is to cut the number of hours worked by their teams. This caused the average weekly earnings, which is a good reflection of take-home pay, to fall 0.1% from March. Overall, the data suggests softening in the labor sector. And again, this could pressure the Fed to cut rates sooner if this trend continues. We shall see. I know when that jobs report came out, there was some chatter online, but like, woohoo, yay. And it's like, dude, a bunch of people just lost their jobs. Like, it's not celebration. It's just, you got to figure this stuff out. What's good for one is not always good for the other. All right, moving on to the next story here. Private payrolls beats estimates. So the source here is ADP. And again, nice little images to go through. I encourage you to check this image out because it gives a lot of the story behind the data that I'm reading here. ADP's employment report showed that the private payrolls rose more than expected in April, led by another boost from the leisure and hospitality sector. Employers added 192,000 new jobs versus the 175,000 had been forecasted, while job growth in February was also revised higher by 24,000 jobs. Pretty wild. We see job losses there. We see job gains here through ADP. So you had ADP's chief economist, Neela Richardson, noted that, quote, hiring was broad-based in April, close quote, with only the information sector posting losses. Growth among small businesses remained muted, however, as businesses with fewer than 50 employees added 38,000 jobs versus 160,000 new jobs added among medium and large companies combined. Annual pay gains for job stayers have been decelerating, with ADP reporting an average increase of 5% in April versus 5.1% in March. Job changers saw an average increase of 9.3%, while this was a decline also from 10.1% in March. It's above the level seen at the start of the year. Job openings. Here's the next story. Job openings hit a 3-year low. So the latest job openings and labor turnover survey, also known as JOLTS, so that's the job openings and labor turnover survey, showed that job openings contracted to 8.488 million in March, down from 8.813 million. So about, what is that, 330 something thousand jobs no longer there. From February. And that number of the 8.488 million is well below estimates. The hiring rate fell from 3.7 to 3.5%, while the quit rate fell from 2.2% to 2.1%. So basically, hiring rate fell to 3.5 and the quit rate fell to 2.1%. Story here is, the bottom line is, job openings have reached their lowest level since March of 21 and are now well below the high of 12 million hit in 2022, suggesting some of the softness in the labor sector. Plus, the quit rate is the lowest level since 2018 other than COVID. This also shows some labor sector weakness, as lower quit rates suggest less poaching from other companies and fewer people feeling confident about finding new employment. I don't know anybody who would willingly quit right now. It's a bad time to go out there on your own for a lot of people. Here's the next story. Trends in unemployment persist. So the initial jobless claims were flat in the latest week as 208,000 people filed for unemployment benefits for the first time. Continuing claims also held steady, with 1.774 million people still receiving benefits after filing their initial claim. What's the bottom line here? The low level of initial jobless claims suggests that employers are still trying to keep their workers, yet continuing claims are still trending near some of the hottest levels we've seen in recent years, as challenges remain for job seekers searching for the next position. Yeah. And we're going to continue here. Home price gains continue. So this one comes from Case-Shiller's Home Price Index, and we see, again, nice bar chart, some quotes on here. And, it looks like it's maybe looking good. So the Case-Shiller Home Price Index, which is considered the, quote, gold standard for appreciation, showed the home prices nationwide rose 0.4% from January to February after a seasonal adjustment. Home values in February were also 6.4% higher than a year earlier, which is the fastest annual rate since November of 22. The Federal Housing Finance Agency, that's known as FHFA, that house price index also reported a 1.2% jump in home prices from January to February, with prices 7% higher than the previous year. Remember, the FHFA is specific, right? So it doesn't include cash buyers. It doesn't include loans that exceed the FHFA limits. And because of this, there might be some differences between the FHFA's report and the Case-Shiller. So sometimes that's why you see differences. Bottom line here is the S&P DJI's head of commodities, Brian D. Luke, confirmed that national home prices are, quote, at or near all-time highs, close quote, with all 20 cities in their composite index once again posting annual price increases. Home values are expected to remain supported this year as buyers' demand still outpaces tight supply. These indexes show that home ownership remains a fantastic opportunity to create wealth through gains. Listen, I was actually at lunch, brunch yesterday, and we were talking about this. We were talking about home ownership, and I still think that the information, and this is me being completely speculative. Like I have no information, real information behind this. It's just me being me. But I still see there's a trend. A trend is as people in their 50s like me have parents in their 80s like me, and you're going to see this combining of housing. I that's what I see. And then you also have people not like me who have younger kids. My kids are in their 30s and 20s, and so my kids are out. Like they're not living with me anymore. But I'm seeing what I'm watching is this confluence in I see a confluence of generations with these huge houses that are out there with underutilized space. And whether you want to call them en suites or you want to call them multi-generational housing, I don't know what you want to call them, but I see that happening. I think there's always this stigma like, oh, I don't want to live with my parents, or I don't want to live with my kids if you're a parent, that kind of a thing. And I think we need to kind of get through that. I happen to be traveling to Seattle. I'm in Seattle right now, and there are apartments everywhere. 500 to 600 square feet is going for $2,200 a month. That's just, the market. Like, and you can't find places like you have to make decisions like that. So, housing shortage is real. Finding places to live is real. And, you can get into all kinds of debates about building code and we need to change things like that to get more housing or we need more construction. But I still think that prices are going to continue to go up. I think housing is going to continue to be less affordable for many unless you come up with some new strategies or if you think about it, some old strategies on how to make things happen. And one of the greatest things I think is transferring wealth. We talk about real estate building wealth, and you transfer it. Seek legal counsel on this, of course. But I know that I was able to help my family through real estate and real estate transfers, and not really focusing on cash or cash buildups, but use real estate. So check it out, guys. It's for real. It really does work. Listen, there's a family hack of the week here. This is National Strawberry Month. Who knew? And there's a great recipe on here for the strawberry granola parfait, courtesy of Good Housekeeping. If you want to check this out, get over to mortgage.community, check out in the market updates, and you'll see that recipe down there around the 13-minute mark. What to look for this week? There is a much quieter week ahead, but highlights include appreciation data from CoreLogic on Tuesday and the latest jobless claims on Thursday. Investors will closely be watching Wednesday's 10-year note and Thursday's 30-year bond auctions for level of demand. If you're watching this ticker up here, we're at the 10-year Treasury at 4.5 right now. Then the U.S. bond, I don't know why I said bond, U.S. mortgage-backed security is at par again. That's good. That's really good. So my name's Larry Bailey, talking to you from Seattle today. Thanks for being with me. Get over to awesometechinc.com and check out everything Awesome Technologies can do for you. I guarantee you won't be disappointed. I'm helping you with automated commissions, helping you with business intelligence analytics, and of course, everything having to help you with the Encompass platform, Byte, or Meridian Link platforms. You be well. We'll see you next time. Take care.